My name is Joe Hadzima. I'm a senior lecturer at the MIT Sloan School of Management. And this is a presentation on company capital structure basics. What are the basic instruments and rights that people have to the assets and returns that a company has? We're going to cover basically where do companies get money. Not all of it is directly from issuance of stock and other securities. And then we're going to look at what we call a capital structure stack. Who has claims to the assets of the company, and how does that all work?
Most young companies need money, which may or may not come as a big surprise, but they do. The number one source they get money from is from their own savings. Whether it's a few $100s or even thousands of dollars, that's what we tend to tap first. And a lot of companies don't get money from any other place. They get money from their own savings, and then after that, they're lucky enough to be cash flow positive. They're profitable. So we talk a lot as if all companies require all sorts of external capital, and the reality is that more than half of young companies get all their funding from a combination of founder savings and then cash flow from the business, and we're out of here. Next up on the list is another one that catches, I think, people by surprise, and that's credit cards. Almost every young company you can think of, to one degree or another, was funded on credit cards. And it is the single largest source of capital for young companies after founder savings. And then the next place where they tend to get money is from friends and family. After I've tapped out my credit card and I've used up all my savings, I turn to people I know and say, hey, will you help me? And that's the third biggest source of capital. And then the next place is banks. And the banks are a totally weird situation because with banks, they get a lot of attention, but they actually fund very, very few young companies. But it's not their fault. You have to think about the way bank lending works and how shareholders want banks to lend. They want them to lend money against secured assets. And young companies don't have any security. They have nothing to secure it against. And the joke in the industry is you can get all the bank funding you want as a startup as long as you don't need it. And then the last piece is venture capitalists. They get the lion's share of the attention, which in some ways is warranted. You know, your Googles and Apples and FedExes and many others all have venture capital money inside of them. But the reality is, and this is from Kaufman research, less than 20% of the fastest growing companies in the United States took any venture money. And that's not because the VCs wouldn't give it to them. It's because they didn't want it or didn't need it, because they had all those other sources. I don't need money, and I certainly don't need money on these terms. Because venture capitalists, unlike banks, they don't lend against secured assets. They give you money in exchange for shares. So they take some of your company away. So my answer is if you don't need it, definitely don't get it. There's no question the venture industry has become staid. The irony is it's intended to fund disruption, and yet it's an industry that had become complacent. And interestingly, over the last 5 or 6 years, we've seen the emergence of other mechanisms for funding, like AngelList, like these kinds of peer-to-peer funding sources, as people increasingly provide capital in smaller amounts, but more people doing it directly. Having said all of that, though, venture capitalists are hugely important for those young companies that don't have access to bank money, but are growth companies. They have the prospect of being a $5 million or a $10 million company in a couple of years, and they need that growth capital to get there quickly. So it's a race. And the way you play the race is by getting money from people like venture capitalists who give you the money so you can compete with other people who are racing as fast as you are. If you can run a company off cash flow and some combination of credit card, your own savings, and friends and family, Bob's your uncle. Run. Keep all the equity, because there's no better thing than being in full control of your own destiny.
Well, as you can see from the Kaufman video, there are many sources for money for companies. One thing they did not, a couple things they didn't talk about included when they say cash flow, that's basically customers, where you go out. Typical way for technology startups would be to go do consulting, learn what the customer wants, and get paid for that, and eventually use that money to develop the product and a better understanding of the product. There are all sorts of funds from the SBIR, Small Business Innovation Research Program, that the federal government has, where you can get paid grants to do things, and it's sort of non-dilutive funding in the sense that they don't take any ownership interest. There are business plan competitions and accelerators and a variety of other sources that our early stage companies would typically do. So let's, however, for this purpose, look at more traditional funding and say, okay, when investors come in, you know, what do they get, and where do things fit? So for that, we're going to talk about the capital structure stack. Now, if you think about the company as having value, either in assets or potential acquisition value, and who has claims on that value, and we think of the claims as a stack, where the people at the top of the stack have first crack at the assets. That's what we're talking about. And so at the top of the stack of capital structure is a secured debt. This is debt, typically money loaned, that is secured by assets. As you saw in the video, small companies don't usually have much in the way of assets, but if there were assets, say a loan to purchase property or equipment, the lender would take a right to have that debt satisfied out of the very thing that they're funding. And so if that debt comes due and you don't pay it, they can take the asset, sell it, and apply the proceeds to the debt plus their expenses. If the amount they get is not sufficient to cover the debt, the balance becomes unsecured debt. That's the next part of the stack. Unsecured debt is any debt you have, any obligations you have that are not secured by assets. So this would include, you know, vendors, people you buy stuff from, all sorts of things where there's no specific security interest granted. And beneath that is the concept of, so for example, credit card debt. If you saw in the video that many companies use credit cards to get going. Actually there, you probably would not be able to get a credit card, the company alone. It would probably be you, the entrepreneur. So it's actually your obligations, not the company's obligations. If you borrow money from a bank, probably you're not going to give it to a small company. You might give it to the company if you guarantee it, if you have the wealth to do that. So secured debt, unsecured debt. Below that is a thing called subordinated debt. Not something you're going to see in early stage companies, but this came out in prevalence mainly in the LBO takeover era, where it was, people figured out that if you had subordinated debt, you could get superior returns. So subordinated debt means they've agreed to, contractually with all the other debt holders, that the holder of the subordinated debt will get paid after all the other debt holders. And so it's the last bit of debt before we get to equity. And subordinated debt was structured in a way that it had some superior returns beyond just repayment of the debt. So that's why it was popular in these complex takeover deals. So when we get to equity, we're talking about who actually has ownership of the company. The debt people have claims against the company. The stockholders, the equity holders, have ownership. At the top of the stack is preferred stock. By definition, it's preferred to other stock. Typically done, venture capital investing would be done with preferred stock. There's a whole other video about the terms of those kind of things that you should check out if you have an interest. And at the bottom of the stack is common stock. Common stock represents the residual value of the company after all the other people have been paid off. If it's a startup, it's worth very little. If it's Microsoft and you're Bill Gates, you're one of the richest guys in the world. So Depends on how big the company grows, what its value is. The common stock could be worth little or could be worth a lot. Now, just to go over a little more detailed, debts are typically for borrowed money, although you could have a creditor, a person who lends money or has a claim on the company, who would typically either lend money to the company or advance funds, but it could also be somebody who is able to sue the company and recover, say for a slip and fall case. They would be a form of a creditor. For traditional borrowed money, this is gets paid back with a stipulated rate of interest with little or no upside. You think of interest as the rent you pay to use the money, but you don't own it, you have to give it back. Some banks like Silicon Valley Bank, who specialize in lending to venture capital-backed companies, will do so and get warrants, we'll talk about in a moment, rights to acquire stock as sort of a compensation for taking that risk. Now, when we get to the equity part, the stock part, preferred stock, again, there's a whole video on the terms of these, getting into more details, typically given to VCs, venture capitalists, and investors. They have a liquidation preference, meaning they come before the other shareholders if the company is liquidated, which could mean either going out of business or being acquired in a positive sense. The preferred stock might be convertible into common stock to get some upside. The conversion, the rate at which you convert is subject to anti-dilution to protect against the company having to raise money at lower valuations. That means the earlier investors would get more for their shares, more common shares when they convert. By the way, this all comes out of the common stockholders, the founders. They would have typically board representation rights and rights to veto further rounds of financing or the terms of them. So preferred has a number of things that you'll read or hear about in that video if you watch it. Common stock, again, is the bottom of the stack, given to founders, employees, maybe consultants. No preferences, no convertibility. There's nothing to convert to because it is it. So residual value after everyone else gets theirs. There can be classes of stock, including classes of preferred, but in the common context, voting and non-voting are used. And there can be different voting rights. During the unicorn thing where people were going public at high valuations, where it was very valuable perception on Wall Street that these companies were worth a lot, many of the founding teams still in place were able to get a class of stock that had superior voting rights. So instead of 1 vote per share, 10 or 100 votes per share. Not something in the long history of Wall Street that is typically done, but because of the bubbly nature of the unicorns, Wall Street was willing to give up those rights. And you'll see those in some prominent companies. Now, options and warrants, these are rights to acquire securities at set times for a given price. Options are usually the term we use for things that are given to service providers. Warrants are another term. They're very similar, slightly different rules, but those are part of the capital stock. Now, if we look at, how does a capital structure of a company change over time? Well, for a startup, the common stock is pretty much it. And there might be a little bit of debt at the top. You purchased some things, haven't paid for them yet, but mostly all common stock. When the first round of outside funding comes in, if say a venture round, you'll see preferred stock comes in. They take a portion of the stack above the common, anywhere from maybe 20 to 40%, depends. And then because there's more money in the company, it's certainly further along because it's able to attract outside capital. It's probably got more unsecured debt because people are willing to advance funds and do business with you. With a leveraged buyout, you get a complex capital structure with secured debt maybe at the top, unsecured debt, some subordinated debt, preferred stock, common stock. So very complex capital structure in an LBO situation. And when you get to be somebody like Microsoft, a later stage, a successful company, mostly all common stock with some unsecured debt because it's a big business, and maybe some secured debt for mortgages or money borrowed for plant, equipment, offices, that sort of thing. So the capital structure changes over time. Now, just so we have terminology straight, if we think, well, let's focus on common stock here for a moment and say what counts in common stock. So some terms. The authorized shares are set forth in the charter, the document that's on file with the Secretary of State of the state in which the company is incorporated. In Delaware, that's called the Certificate of Incorporation. In there, it'll say the company is authorized to issue, say, 300,000 shares of common stock, and later maybe a number of shares of preferred stock. But let's focus on common for this. When those shares of common are given out or issued, in this case, 150,000. Later, a company might buy back some of those shares when employees leave or other situations. Those are called treasury shares. In this example, 25,000 shares have been bought back. So at the end of the day, we have issued and outstanding 125,000 shares. Now, out of the original 300,000, there are 150,000 that have not been issued. And some of those might be reserved for issuance under option plans or conversion of preferred stock. And what's left is the authorized, the non-issued or reserved. And the question is, the company is sold for $150 million. You own one share of stock. How much do you get? Well, it's based on the issued and outstanding shares in the first instance. And if the options have been granted and are exercisable, you might include the shares that are exercised. They become issued and outstanding at that point. So in the case of just straightforward issued and outstanding, it would be 150 million divided by 125,000 shares, or you get $1,200 for your share of stock. In the case of options having been exercised and the total number of shares outstanding are 175,000, then you would get $8.57 a share. So that's some basics around capital structure. There's some other topics that are covered by other videos. For example, what instruments do investors get? What part of the stack do they get? And in that video, we talk about convertible notes and safes, a simple agreement for future equity, as something that people use. And preferred stock, as we've talked about here, we'll get into the types and deal terms in that other video. We also haven't talked about how you would use stock and options as compensation for services for employees or consultants, board directors, that type of thing. There's a video on that that also covers allocation of founder shares, how people think about that, and a very important thing to know about, which is the Section 83 of the Internal Revenue Code trap that you can get stuck with income when you didn't think you were going to have any, and how to avoid that. We'll talk in that video about various instruments you can use for compensation, restricted stock, incentive stock options, those are given to employees only, and non-qualified stock options. And we'll talk about some of the regulatory issues around that you should be aware about. So with that, that's a quick introduction to capital structure basics. If you have questions about this, feel free to send me an email and I'll do my best to answer. And do look for those other videos if you want to get a more complete picture about how all of this works.